Stop everything. Close every distraction. Because what happened overnight while you were sleeping is the setup for the most explosive move in precious metals history. And if you don't understand what's really happening right now, if you fall for the trap that's being set at this very moment, you're going to get shaken out of your position 24 hours before the biggest wealth transfer event of your lifetime. It's January 7th, 2026. While you were sleeping, while the Western markets were closed, while most retail traders were dreaming about their tiny profits, the Asian session detonated. Silver surged to $83 per ounce. $83. We came within $1 of breaking the critical $84 resistance level that represents the all-time high. And gold absolutely exploded to $4,500 per ounce, now heading straight for $5,000. Let me repeat that because this is not a typo. Gold is trading at $4,500. This is not a drill. This is not speculation. This is the monetary apocalypse happening in real time. When gold moves from $3,800 to $4,500 in a matter of weeks, that's not a bull market. That's a currency crisis. That's the world screaming that the dollar is dying. That's central banks, sovereign wealth funds, and anyone with two brain cells to rub together abandoning fiat currency and rushing into the only money that has survived every empire collapse in human history. Gold at $4,500 means the monetary reset is not coming. It's here, it's now. And if you're not positioned in physical metals, you're about to watch your purchasing power evaporate in real time. But here's where it gets interesting. Here's where I separate myself from every other analyst, every other YouTuber, every other talking head who's going to tell you the same recycled nonsense. I know exactly what some of you are thinking right now. I can hear my haters already. Hey, William, last night you said silver was going to break $84 and it got rejected at 83s. You were wrong. The top is in. Time to sell. Top is in. Let me address this head on because this is the exact mentality that's going to cost you everything. Yes, I said $84 would break. And you know what? Maybe I was wrong about the exact minute it would happen. Maybe I was off by 12 hours or 24 hours. But was I wrong about the fact? Absolutely not. Go back and watch my previous videos. I told you $84 would break this week. Not last night specifically. This week, and we still have 5 more days. What happened at $83 is not a failure. It's not a rejection. It's not the top. It's a classic textbook setup that happens at every major resistance level in every bull market in history. It's a liquidity hunt. It's a trap, and 95% of retail traders are about to walk right into it. Let me explain how this game really works, because if you understand this, you'll never get shaken out of a winning position again. The market just touched $83 and pulled back slightly. What does the average retail trader see? They see a rejection at resistance. They see a potential double top forming. They see the RSI overbought. They see bearish divergence, and they think, this is it. The rally is over. I should sell now and take profits before it crashes. Wrong. Dead wrong. Catastrophically wrong. What you're witnessing is not a top. It's a liquidity deposit. Let me break down what's really happening behind the scenes. When silver approaches a major resistance level like $84, what do you think happens? Every retail trader in the world has their stop losses sitting just above that level. They put their stops at $84.50 or $85 thinking they're being smart. I'll ride the breakout, but protect myself if it fails. The big institutions, the market makers, the whales, they can see all those stop losses. They know exactly where every stop is sitting. They know there are billions of dollars in pending buy orders stacked just above $84. So what do? They touch $83, create the illusion of a rejection, and trigger all the weak hands to sell. They create the expectation of a top. They make it look like resistance is holding. And while the retail traders are panic selling, convinced the rally is over, the smart money is accumulating everything they dump. This is how markets really work. You have to understand that the market moves by creating and collecting liquidity. Liquidity is all that money sitting in stop losses, in limit orders, in the accounts of retail traders who don't have privileged information. That liquidity is the daily bread for the big banks and institutions. Liquidity is like gasoline for your car. You need to fill the tank. Once the tank is full, the car runs like a torpedo. The markets function exactly the same way. They need to collect liquidity to fuel the real move. And right now what we're seeing at $83 is the final fill-up before the rocket launch to $100, $120, $150 and beyond. The rejection at $83 is not weakness. It's strength being disguised as weakness. It's the market creating the expectation of selling so it can do the exact opposite. Now, I need to address something critical because some of you are going to see what I'm about to say and panic. I don't want you to panic. I want you to understand. There are 2 scenarios in play right now. Scenario 1, silver consolidates between $80 and $84 for a few more days, builds a base, and then explodes through $84 in a vertical move that takes us to 100 plus within a week. Scenario 2, silver drops back down to collect the massive liquidity pool sitting around $70, $72, shakes out every weak hand, triggers every stop loss, creates maximum pain and fear, and then launches from that level straight through $84 to 100 plus. Both scenarios end at the same place, triple-digit silver. The only difference is the path. And I'm showing you a chart right now that illustrates exactly where that liquidity is sitting. Look at the volume profile. Look at the unfilled orders. There's a massive cluster of stops and sell orders between $70 and $75s. If the market makers want to maximize their accumulation, if they want to fill their tanks with the maximum amount of gasoline, they could engineer one more flush to that level. Now, before you panic, before you think, oh no, silver is going to crash back to $70, listen to what I'm actually saying. The strong uptrend we're in right now could simply keep going. We might never see $70 again. The momentum is so powerful, the Chinese buying is so aggressive, the Pentagon's desperation is so acute that the market might just say, screw the liquidity at 70s and blast straight through $84 without looking back. We have two possible scenarios. Either it keeps rising, or it corrects to collect liquidity and then rises. Both paths lead to the same destination. This is why I keep telling you the same thing over and over again. The best strategy in a market like this is a wide stop loss and diamond hands. Set your stop below $50 if you're using stops at all, close the chart, and check back in a few months. You'll thank me. And here's something that's going to blow your mind. Do you know that the big banks don't even use stop losses? Think about that for a second. JP Morgan doesn't have a stop loss on their silver position. Bank of America doesn't have a stop loss. China doesn't have a stop loss. Why? Because they have so much liquidity, so much capital, so much staying power that they simply add to positions even when the price goes against them. They're able to hold positions indefinitely until they turn in their favor. This is exactly what's happening with China right now. China buys. If silver goes up, China buys more. If silver goes down, China buys more. If it keeps going down, China buys even more. They keep averaging in until they've accumulated so much metal that they can manipulate the market and watch it grow like foam. Meanwhile, retail traders are getting their stop losses hit every single day, getting shaken out of winning positions, watching from the sidelines as the market does exactly what they thought it would do, just without them in it. The big US banks are losing this war against China. That's inevitable now. They want to protect their dollar at all costs. They want to maintain the illusion that the paper system works. But there comes a moment when the bubble explodes. And many hedge funds, many big banks and institutions have stopped selling and have positioned themselves in long positions because fighting this trend was like swimming against a tsunami, a giant wave that drags you straight to bankruptcy. Look at what just happened. Bank of America, one of the most bearish institutions on precious metals for the last decade, just capitulated. They released a research note with a price target of $309 per ounce for silver. $309. The Death Star just surrendered. When the biggest bear turns into the biggest bull, when the entity that's been suppressing the price for 15 years suddenly says, actually, this thing is going to $300, that's not a warning. That's a white flag. And it's not just Bank of America. Reports are confirming that the Western banking cartel is sitting on a combined short position of 4.4 billion ounces of silver. Let me put that in perspective for you. The entire planet Earth mines about 800 million ounces of silver per year. That's all we produce. The banks are short 4.4 billion ounces. That means they've sold on paper 5.5 times the annual production of the entire human race. They're short 550% of the global supply. In the stock market, when a hedge fund is short 20% of a company's float, we call it a crowded trade. When they're short 100% like GameStop, we call it the mother of all short squeezes. But here, they're short 550%. It's a level of leverage and recklessness that has no parallel in financial history. Every dollar that silver rises costs them $4.4 billion in mark-to-market losses. At Bank of America's target of $309, the losses aren't just painful. They're extinction-level events. But the money isn't even the biggest problem. The biggest problem is physicality. A short position is a promise to deliver. When you're short, you owe someone metal. And the counterparty isn't retail speculators anymore. The counterparty is China. The counterparty is the solar industry. The counterparty is the Pentagon. These entities don't want cash. They can't build solar panels with a check. They can't build missiles with a wire transfer. They demand physical bars. And when they stand for delivery on 4.4 billion ounces and the vault only has 300 million ounces inside, the system breaks. It hits a brick wall at $1,000 MPH. This forces the banks into the open market as buyers. The same entities that have suppressed the price for 20 years are suddenly forced to switch sides. Imagine the panic. They have to buy back 4.4 billion ounces to cover their naked shorts. But who's going to sell to them? Are you going to sell at 83? Is China going to sell at 83? No, we're holding. China is buying. The banks will be bidding against a vacuum. They'll bid $85, no sellers. They'll bid $90, no sellers. They'll bid $100, still no sellers. This is how you get a vertical price move. This is how you get gaps on the chart where no trades even occurred. This is how you get to $300, not in 10 years, but in 10 weeks. While all of this is happening, China just detonated the biggest liquidity bomb in human history. Reports confirm that China has expanded its M2 money supply by 48 trillion yuan. 48 trillion. To give you context, that's roughly double the entire M2 money supply of the United States. Think about the inflation we saw in the US after printing $5 to $6 trillion during the pandemic. Housing exploded, cost of living doubled. Now imagine a monetary bomb nearly 10 times that size detonating in the Asian market. But here's the critical difference. When the US prints money, it goes into the stock market. It goes into Apple, Nvidia, financial derivatives to prop up banks. The Chinese aren't doing that. They're not printing $48 trillion to save real estate developers or pump the Shanghai stock index. They're printing that money with a singular strategic purpose, to convert worthless paper currency into hard assets before the system collapses. They're executing the largest wealth transfer in history. They're taking these newly printed yuan and deploying them like weaponized capital into global commodity markets. They're buying oil, copper, pork, but most aggressively, gold and silver. They're saying to the world, we'll give you this paper we just printed out of thin air, and you'll give us your physical metal that took billions of years to form and millions of dollars to mine. And the West, in its stupidity, is taking the deal. This $48 trillion wall of money is the force that broke the back of the short sellers. Bank of America saw this number, they ran the simulations, they realized that no amount of paper shorting in New York can stop a $48 trillion buying spree from Beijing. If JP Morgan sells 1 billion ounces of paper to suppress the price, China will just print enough yuan to buy all the physical metal those paper contracts represent. The shorts are bringing a knife to a nuclear gunfight. This is why the paper price is becoming irrelevant. The spot price you see on your screen is determined by Western trading hours, but the physical flow is determined by Eastern buying power. And right now, the East has 48 trillion reasons why they're going to win this tug of war. Every time the price dips, Chinese liquidity steps in and buys. They're creating a floor that gets higher every day. They're not trading for profit in dollars. They're trading for survival. They know the US dollar system is ending. They know the debt spiral is mathematical certainty, so they're exiting the burning building first, and they're taking all the valuables with them. Now let's talk about what's happening with gold, because gold is the ultimate truth teller. Gold just hit $4,500 per ounce and is now targeting $5,000. Let that number sink in for a moment. $4,500 per ounce of gold. This is not a normal bull market. This is not even an exceptional bull market. This is a full-blown monetary crisis playing out in real time. When gold moves from historical highs around $3,800 to $4,500 in a matter of weeks, it's sending a message so loud, so clear, so undeniable that even the most committed dollar bulls have to pay attention. Gold doesn't rally 60% because investors are feeling optimistic. Gold rallies 60% because the world has lost faith in fiat currency, because central banks are panicking, because sovereign wealth funds are dumping treasury bonds and buying anything real, because the smartest money on planet Earth has looked at the $35 trillion US debt, the $48 trillion Chinese money printing, the Venezuelan military operations, the COMEX inventory collapse, and decided that the game is over. Gold at $4,500 means the petrodollar is dying. It means the Bretton Woods II system is collapsing. It means we're entering the endgame of the fiat experiment that began in 1971 when Nixon closed the gold window. For 55 years, the world has operated on a system of pure paper money backed by nothing but government promises and military might. And for 55 years, that system has inflated away the purchasing power of every currency on Earth. But now, the inflation has become so extreme, the debt has become so unpayable, the manipulation has become so obvious that confidence is evaporating. Gold at $4,500 is not gold becoming more valuable. Gold at $4,500 is the dollar becoming worthless. It's the market repricing every fiat currency downward to reflect the reality that governments cannot and will not stop printing money. They're trapped in a debt spiral where they have to print to service the interest on the debt they printed yesterday. It's a mathematical death spiral that ends only one way: hyperinflation or default. And hyperinflation is just slow motion default. But here's what's truly terrifying for anyone not holding precious metals. Gold at $4,500 heading to $5,000 means silver at $83 is not expensive. It means silver at $83 is criminally undervalued. Let me show you the math that's keeping the silver shorts awake at night, sweating through their sheets, contemplating financial oblivion. The current gold to silver ratio with gold at $4,500 and silver at $83 is approximately 54.1. That means it takes 54 ounces of silver to buy 1 ounce of gold. Now let's look at the historical ratios. Throughout most of human history, going back thousands of years, the ratio has been around 15.1 to 21. During the peak of the 1980 silver mania, the ratio hit 15.1. Even in 2011, during the last silver bull market, we saw ratios compressed to 30.1. So let's run the calculations. If the gold to silver ratio normalizes to just 21, which is conservative by historical standards, and gold is at $4,500, then silver should be at $225 per ounce. $225, not $83, not $100, not even $150. $225 is the mathematically correct price for silver based on historical norms and current gold prices. But it gets better. If we go to the 1980 ratio of 15:1, which happens at the peak of silver manias when industrial demand combines with investment panic, then $4,500 gold implies $300 silver, $300 per ounce. This is not speculation. This is not hopium. This is basic arithmetic. Gold is already at $4,500. The ratio will normalize. It always does, which means silver has to catch up. And if gold continues to $5,000, as everyone from Bank of America to the Chinese central bank expects, then at a 21 ratio, silver goes to $250. At a 15.1 ratio, silver goes to $333. These aren't pie-in-the-sky predictions. These are conservative mathematical projections based on thousands of years of historical precedent. Do you understand what this means? Silver at $83 is not expensive. Silver at $83 is the opportunity of multiple lifetimes. Silver at $83 when gold is at $4,500 and heading to $5,000, when China is printing $48 trillion yuan, when the Pentagon is building $7.4 billion smelters, when the banks are short 4.4 billion ounces they cannot deliver, when COMEX inventory is dropping to zero by January 31st, silver at $83 is theft. It's a gift. It's the market handing you a winning lottery ticket and begging you to take it. But most retail traders won't take it. They'll see the rejection at $83, they'll see the slight pullback, they'll see the RSI cooling off, and they'll sell. They'll give away their silver at $83 because they're scared of a 5% correction, and they'll watch from the sidelines as it explodes to $150, $200, $250 over the next 6 months. And they'll be the ones posting on Reddit about how they knew it would happen but got shaken out too early. Don't be that person. Understand what gold at $4,500 means for silver. Understand that the ratio compression is not optional. It's mathematical. It's inevitable. It's the market correcting decades of manipulation, suppression, and paper games. When gold reprices 60% higher, silver doesn't stay flat. Silver catches up, and because silver starts from a lower base, because silver has been more heavily suppressed, because silver has both monetary and industrial demand, silver doesn't just match gold's percentage gains. Silver exceeds them. This is why silver is called gold on steroids. When gold moves 60%, silver moves 200%. When gold goes parabolic, silver goes thermonuclear. And we're watching this happen right now. Gold just moved from $3,800 to $4,500. That's a 60% gain. But silver has only moved from $70 to $83. That's less than 20%. The rubber band is stretched to its breaking point. The ratio is so distorted, so far from historical norms, that the snapback is going to be violent. We're talking about silver moving $50, $100 in a single week when it finally breaks. This is why the rejection at $83 is so meaningless. Whether silver consolidates at $83 or pulls back to $75 or even $70 doesn't matter. The destination is 200 plus. The path is irrelevant. What matters is that you're holding physical metal when the ratio compression happens. Because when it happens fast. You won't have time to buy. Premiums will explode from $15 over spot to $50 over spot overnight. Dealers will run out of inventory. Online retailers will suspend sales. You'll be calling everyone you know trying to find metal, and there will be none available at any price. The rejection at $83 that has everyone worried is nothing but noise in the context of gold at $4,500 targeting $5,000. It's like worrying about a 2% dip in your stock portfolio when your house just increased in value by 60%. It's like selling your winning lottery ticket because the numbers aren't perfectly aligned. It's insanity. Here's what the smart money understands that retail doesn't. When gold makes a massive move like we just saw, silver always follows. Always. Without exception. The lag time can be days or weeks, but it always follows. And the magnitude of silver's move is always larger. This is not opinion. This is historical fact backed by 100 years of price data. In 1979-1980, gold went from $200 to $850. That's a 325% gain. Silver went from $5 to $50. That's a 900% gain. In 2008-2011, gold went from $720 to $1,900. That's a 164% gain. Silver went from $9 to $49. That's a 444% gain. The pattern is consistent. Silver outperforms gold on the upside, and we're watching the setup for the biggest gold rally in history, which means we're about to witness the biggest silver rally in history. Gold moving to $4,500 and targeting $5,000 is the starter pistol firing. It's the signal that the race has begun. It's the proof that everything we've been saying about monetary collapse, dollar debasement, and the repricing of hard assets is not theory. It's reality. It's happening right now. And if you're not positioned in physical silver, you're standing on the beach watching the tsunami approach and thinking you have time to run. You don't have time. The wave is here, the water is already pulling back, and in a few days, maybe a few weeks at most, the full force of that wave is going to hit. Silver is going to break $84, blast through $100, hit $120, and then enter price discovery mode where there are no sellers, and the only question is how high can it go before someone blinks. The big US banks are losing this war against China. That's inevitable now. They want to protect their dollar at all costs. They want to maintain the illusion that the paper system works. But there comes a moment when the bubble explodes, and many hedge funds, many big banks and institutions have stopped selling and have positioned themselves in long positions because fighting this trend was like swimming against a tsunami, a giant wave that drags you straight to bankruptcy. Look at what gold just did. It moved 60% higher in a few weeks. That's not a market, that's a rout. That's a collapse of confidence so severe that the only remaining safe haven is physical metal. The banks saw that move, they saw their models break, they saw their assumptions shatter, and they realized that fighting this trend would destroy them. So they capitulated. They flipped from short to long. They joined the side that's winning. This is why Bank of America just released a target of $309 for silver. This is why institutions that have been bearish for a decade are suddenly scrambling to accumulate physical metal. This is why JP Morgan is financing a $7.4 billion smelter in Tennessee. They know what's coming. They've seen the gold price. They've done the ratio math. They know that silver at $83 is temporary insanity that will be corrected violently and soon. Now let me tell you what's going to happen over the next few days and weeks. We have two scenarios, and I want you to understand both of them so you don't panic, so you don't make emotional decisions, so you don't give away your silver at the worst possible moment. Scenario 1, silver consolidates between $80 and $84 for the next few days. It builds a base, it digests the gains, the weak hands get bored and sell, the patient money accumulates, and then, probably by the end of this week, we assault $84 with conviction, we break through on massive volume, every algorithm flips bullish, every fund that was short gets liquidated, and we're at $100 within 48 hours of breaking 84s. From there, it's a straight shot to $120, $150, $200 as the ratio compression accelerates and the short covering panic intensifies. Scenario 2. The market makers engineer one more liquidity grab. They see all the stops clustered around 70-72s. They see billions of dollars in retail positions that can be liquidated with one coordinated smash. So they drop the price from $83 to $70 in a violent, fear-inducing sell-off. Retail panics. Stop losses trigger. Margin calls force liquidations. The message boards fill with, "I told you so," and "the rally is over," and "I knew I should have sold at $83. And while everyone is panicking, China is buying with both hands. The Pentagon is buying. JP Morgan is buying. They're absorbing every ounce of metal that retail is dumping. And then, after maximum pain has been inflicted, after every weak hand has been shaken out, the price reverses. It gaps up from $70 to $78 overnight, then $85, then $95, and it never looks back. The people who sold at $70 watch in horror as the market does exactly what they thought it would do, just without them in it. Both scenarios end at the same destination: triple-digit silver, 200 plus silver, ratio compression to 21 or 15.1, the Great Reset, the repricing of real assets, the wealth transfer from paper holders to metal holders. The only difference is the path, and you cannot predict the path. Nobody can. The market makers will take whichever route inflicts maximum pain on the maximum number of participants. This is why I keep telling you the same strategy over and over. Wide stops, diamond hands, don't overthink it. Set your stop loss below $50 if you're using stops. Better yet, don't use stops at all if you're holding physical. Just buy, hold, and wait. The destination is guaranteed. The timeline might vary by weeks or months, but the outcome is mathematical certainty. And here's the thing that retail traders don't understand, but institutions do. The big banks don't use stop losses. China doesn't use stop losses. The Pentagon doesn't use stop losses. Why? Because they have infinite capital relative to the position size. Because they're not trading for short-term gains. Because they're accumulating a strategic resource that they plan to hold for decades. When JP Morgan buys silver and the price drops $5, they don't panic and sell. They buy more. When China sees silver drop from $83 to $78, they don't hit the sell button. They deploy another $10 billion in buying. This is the mentality of winners. This is how empires are built. This is how wealth is transferred from the impatient to the patient, from the emotional to the calculated, from the retail trader to the central bank. You need to think like a central bank. You need to understand that you're in the same trade as the most powerful institutions on Earth. They're buying physical silver because they know it's the most undervalued strategic asset on the planet. They know gold at $4,500 means silver has to go to 200 plus. They know the supply is collapsing. They know the demand is exploding. They know the paper market is dying. They know the repricing is inevitable. The only question is whether you have the conviction to hold through the volatility. Whether you can ignore the noise, the FUD, the bearish YouTubers, the trolls in the comment section saying, I told you $83 was the top. Whether you can look at gold at $4,500 and understand what it means for silver. Whether you can do the ratio math and see that $83 silver is the buying opportunity of multiple lifetimes. Because I promise you, 6 months from now, you're not going to care whether you bought at $70 or $83. When silver is trading at $225 and the gold to silver ratio has normalized to 21, the difference between $70 and $83 is noise. It's rounding error. It's completely irrelevant. What matters is that you were in the trade. What matters is that you owned physical metal before the COMEX default, before the paper market collapsed, before the price discovery mechanism shifted permanently from New York to Shanghai, before silver was repriced to reflect its true value as the scarcest strategic metal on Earth. The window is closing. Not in months, not in weeks, in days, possibly hours. The gold move to $4,500 is the final warning siren. It's the market screaming at you that the system is breaking, that fiat currency is dying, that only physical metal will survive what's coming. Silver at $83, rejecting from $84 is not a reason to sell. It's a gift. It's one more chance to buy before the vertical move begins. So here's my final instruction. Here's the battle plan for the rest of January 2026. If you own physical silver, you hold. You don't sell at 80 thrice. You don't sell at 90. You don't sell at $100. You don't even consider selling until the gold to silver ratio normalizes below 21. That's your signal. That's when you trade silver for gold, not before. If you're trading paper silver with leverage, you need a wide stop below $50 and you need to accept that you might get hit on a wick before the real move. Consider converting to physical while you still can, because the counterparty risk is real. The COMEX default risk is real. The cash settlement risk is real. If you don't own silver yet, you buy now. You don't wait for $70. You don't wait for perfect confirmation. You buy at $83 because when gold is at $4,500 heading to $5,000, when the ratio compression is inevitable, when China is deploying $48 trillion in buying power, when the banks have capitulated and flipped long, $83 silver is going to look like the opportunity you kick yourself for missing for the rest of your life. Set your stop below $50. Close the chart. Check back in a few months. You'll thank me. Gold at $4,500 targeting $5,000 is the proof that everything we've been saying is true. The monetary collapse is here. The Great Reset is happening. The repricing of hard assets is underway. Silver at $83 is not the destination. It's mile marker one on the road to $300. The rejection at resistance is meaningless noise. The ratio math is irrefutable. The fundamentals have never been stronger. The setup has never been more bullish. Hold the line. Trust the process. And whatever you do, don't sell your physical silver for paper dollars that are being printed into oblivion. The war is won. The enemy has surrendered. Gold at $4,500 is the white flag. Now we wait for silver to catch up. And when it does, when that ratio compresses, when silver moves from $83 to $250 in a matter of weeks, you'll look back at this moment and realize it was the most important financial decision of your life. Silver at $83, gold at $4,500. The math doesn't lie. The destination is certain. The only variable is whether you're holding metal when we get there.